Hello. It is I, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall, and I have returned today with another ADH Wealth Solution. Before we get started, make sure you hit that like, drop a comment, and if you're new, subscribe and hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, if you'd like to contribute to channel growth, my information is on the screen. So today, I want to share with you a few things and reasons why it's important to have life insurance at what's called inflection points. And what are inflection points? Well, inflection points are ages or periods in your life when things change. Now, this can be physically, mentally, emotionally, or financially. In terms of things that are easy to understand, most people understand an inflection happens when you turn 25 and are able to do things like rent a car, or 21 and able to have an alcoholic beverage. Those are inflection points. So those inflection points are what we're going to talk about as to why it's important to have life insurance in your 30s, your 40s, your 50s, but especially in your 20s. Now we'll get back to the 20s at the very end. But I want to show 30s because in the 30s, especially for Black men, there generally is an inflection point. At around 35, you start to go through some changes. You start to feel or become more responsible. Now, often it may happen a little earlier because you may have kids. But let's take a look at the 30s. So give me 1 second here. And let me increase this. So, if you're like many adults in their 30s, you're going through a whole lot of big life changes. Maybe you're buying your first home, getting married, having kids, or starting a business. Whatever you're going through as a 30-something, chances are there's one thing you may not be thinking of, and that's life insurance. So why would you need life insurance in your 30s? So here's a few potential life changes that take place in your 30s, all of which are great reasons to consider life insurance now, not later. You bought or are saving to buy a home. Purchasing a home is a huge achievement and in many cases comes with a huge mortgage. Life insurance is a way to guarantee that your financial obligations will be covered in the event of your passing. If you bought a home with a partner or spouse, and if you have children, that life policy will help to ensure that your family can comfortably afford to pay the rest of the mortgage and continue living in that home. Okay? If you've had children, okay? If you have or took on significant debt, okay? In addition to a mortgage, people in their 30s have or do take on significant debt. Things like student loans, credit cards, and small business loans, or other major life changes like medical debt that require financial assistance. So a life insurance policy allows you to pay off outstanding debt left in the wake of your passing. Now, these are all talking about death, but they're also talking about life events. And the ill part about life insurance is that if you get a proper policy, you can actually build cash value. And that cash value can be used while you're alive. But let's continue to read the advertisement. What kind of life insurance should you get in your 30s? If you're in your 30s, term life insurance is usually the best bet. Term life insurance is affordable, straightforward, and can be tailored to provide coverage during the years you need it most. For example, if you're a parent and your child will graduate from college in 18 years, you may want to consider a 20-year term policy. That way you'll know that no matter what happens, your dependents won't be saddled with the cost of education in the event that they can no longer rely on your income. So this is that premise of buy term, invest the rest. but there's a bunch of different ways that you can actually invest the rest. It's a great idea to buy a term policy because it's cheap and you can get a boatload of coverage. So that's when you get a $5 million amount of coverage, and it covers you for 30 years, and it costs you $500 a month. But where else are you going, besides Vegas, where you going to put down $500 and get back $5 million? I understand you die, but where you going to do that? Now, the bottom line on life insurance in your 30s is at the end of the day, life insurance is a vital part of your financial legacy. And opting to invest in it early is a wise step toward protecting your family and easing your mind. While a strong majority of Americans, 82%, value leaving behind a strong financial legacy, a significant number of people, 38%, lack the confidence that they will do so. By getting in life insurance in your 30s, you can take action now to solidify your own financial future and the financial future of your family. So that's some of the reasons that it's important to get life insurance in your 30s. Now, there's also something that's cool about that. What's going on, brother? So I was actually on Anton Daniels the other day, and I need to double check and make sure he got my email. We will be setting up a time for me to come out and speak on his show further about insurance because he was interested in it as well. And, I like to get all in the nitty gritty. Now, he intends to use it on his Patreon. We'll figure something out and discuss something. As you guys know, I am fee service based. A brother like that, I know, wouldn't mind paying the fee. He pours into people, so I don't doubt it. But for the knowledge that I'm given and that I'm thankful that he's going to allow me to give and pour into people, everybody, if you aren't on his Patreon, join it. Maybe I'll create a Patreon. If you're new to my YouTube, follow it. I'm pretty much the same across all platforms, the All-Star Advisor, except for on Twitter, it's Hall, AKA. But let's get back into it. So that is for your 30s. Let's see. It says, "Hey, I heard that on his show today. He mentioned you but not by name." Yeah, that's fine. That's all good. We're gonna get together and speak, and like I said, I'm gonna do the same thing there that I do here. Probably a little more in depth because he wants to have multiple sessions, which makes sense. Probably what I'll do is dive deep into each policy type. Kind of like I do here. I explain to him that I compare Benzes to life insurance. So moving on, let's take a look at the importance of having life insurance in your 40s, right? Because there's a lot of men in this space. Shit, I'm encroaching my 40s, so it's pretty important in my 40s too, as I'm learning. So let's take a look here. Why it's important to have life insurance in your 40s. As a 40-something, you're likely in the midst of some financially demanding years with a complex mix of responsibilities and assets on your plate that you want to protect in the unfortunate event of your untimely passing. Ensuring you've locked down life insurance in your 40s will help your family stay financially secure. Here are a few critical reasons why it may make sense to get life insurance in your 40s. And folks, if y'all want more content like this from me, hit the Cash App. So I can definitely grow and bring you better content. It definitely helps things like engineers and getting songs produced, because I don't want to keep getting hit with copyright strikes. I know some people who produce beats. They aren't cheap. I used to make beats myself, but I don't anymore. So I want to just pay somebody to do it. I don't know. It's a comfortable lifestyle. Anyway, so here are a few critical reasons why it may make sense to get life insurance in your 40s. And I'm going to try and speed through this because the game is on right now. And my wife is a big Giants fan. And I'm not a Giants fan at all. Well, I kind of am. I liked them in 2007. And well, what ended up happening was I was like, I should pick an NFC team. And I picked the Giants. And then they beat my Patriots. And then I hated them. So anyway, you want to plan for your children's future. Ensuring that as your kids grow, they're financially protected is a major reason many 40-somethings choose to purchase life insurance. Not only are they one of your largest responsibilities, but child expenses range from the long term, like educational planning, to monthly, like childcare, school supplies, groceries, and clothing. Identifying and protecting your lifestyle. By having a life insurance policy, you're able to help your children as well as your significant other with costs if something were to happen to you. If you don't want to pass down debt. So actually, hold on, because Anton also said something on his show that was very important as well. Hold on, let me just take a look back at the text here. Yeah. He mentioned that when his dad died, his dad didn't have life insurance, and that he had to pay for everything, and that it wasn't nice for him. Apparently, he didn't enjoy it. But it's something. It's definitely something to speak of. So let's see. A recent Experian study showed that those aged 40 to 55, Gen X, are likely to carry the most debt of any age group at about $136,000, which is $40,000 more than the second highest group, baby boomers. Do you want to pass down these expenses to your loved ones if you were to pass away? Would your family be able to handle payments without any financial assistance? If your answers are no, getting life insurance in your 40s might be a good plan. You want your spouse to have a safety net. So although your home may have two breadwinners, losing you unexpectedly could negatively impact your spouse's financial stability or current living situation. Factoring in mortgages, monthly bills, child expenses, health costs, and their retirement, if you don't have any or enough financial coverage, your significant other could have a monetary burden put on their shoulders, especially if your spouse is a stay-at-home parent. Knowing your family can be protected with a financial plan if your income were to be lost can be comforting. You want your elderly family members cared for. There's also something in life insurance called a hybrid policy, and hybrid policies have what's called long-term care compiled into it. What long-term care is when elder person gets when Uncle Lou is 67 and needs to go to live with somebody, you can pay to put them in a retirement home. And those things aren't cheap. When your elderly loved ones rely on you, your passing would raise many questions for uncertainties. How would they maintain their standard of care? Will they be able to afford assisted living? What will their options be if they lost your supportive income? Whether it's paying for medical bills or living costs, having life insurance policy could help cover their care. The bottom line on life insurance in your 40s. Knowing you've got proper, affordable, and straightforward life insurance to support the financial obligations you have can be comforting and help you feel confident you've secured your financial legacy. So that's some of the importance of getting life insurance in your 40s. So let's see, it says what channel? Anton Daniels was the channel. Let's see, now we're going to take a look at life insurance in our 50s and above. And we're also going to talk about what this month is. So this month is called Liam, right? September is Liam, Liam, Life Insurance Awareness Month. Now, y'all will remember I put in here, and I'm going to put it in the chat again, the website, www.lifehappens.org. So y'all could go see Kelly Rowland fine ass telling y'all that she supports life insurance and she supports Liam, the Life Insurance Awareness Month. So that's LIAM, Life Insurance Awareness Month. Okay. So, where were we? We were looking at our 50s, correct? Y'all, hold on for me for a second. I need to go grab some water. Like y'all know, I'd like to be hydrated. Give me a brief moment. I shall return. Let me make the screen bigger for y'all. All right, I'm back, y'all. I'm back. Salute, KP. What's going on, brother? So, at this point, we are looking at the 50s. And let's see, where was I? Let me grab my screen, and I'll get back into it with y'all. So, the importance of having life insurance in your 50s and up. So there are many men who are also in this age range, especially in this space, or encroaching this age range. I got a brother who's 45, right? 5 years goes by fast. He's going to be 50 in 5 years, right? I got dudes, we know dudes in this space who are 49, 47, 42. 10 years goes by fast. I feel like I turned 30 yesterday. I'm about to be 40. Y'all brothers are telling me life's just beginning at 40. I get it, but that concept is crazy. That's why I'm going to do the 20s last. Because a lot of this is not telling you, a lot of this is talking about death, right? But it's not talking about life. And that's why I don't like life insurance advertisement, right? But that's why you got me, the all-star advisor, and I spit it very differently than others. Also because I have a very different perspective. So it changes things. As we know, 2008, 3 days before Mother's Day, I got shot 5 times in front of my mother in Trefo, Winston-Salem, North Carolina. Now I sell life insurance. So, when you reach your 50s, you have many things to look forward to. Your kids are most likely older or already grown, and you're probably more financially secure than ever before. However, when it comes to financial planning for your 50s and up, does life insurance have a place? Why people 50 or older should have life insurance. Our Financial Legacy Index found that many Americans have not taken critical steps towards protecting their family's financial future if the unexpected happens. 52% of Americans say that they often worry about the financial situation they would leave behind for their children/future children after they pass away. When weighing your options, ask yourself, does someone rely on me or my income for their well-being? If the answer is yes, you likely need life insurance. Ladies and gentlemen, before we continue, make sure you subscribe, hit that like, drop a comment, hit that notification bell so you're made aware every time I release new content. And as always, share. Lastly, if you'd like to contribute to channel growth, my information is on the screen. So, here are some additional reasons you may need life insurance if you're 50 years or older. You have financially dependent children or grandchildren. You're paying off debts like a mortgage or credit card balance. I'm going to talk about this one here, a mortgage. So the average American that purchases their home is about age 52. You know what? I want to Google that. Let's Google that really quick. What's the average age of a home buyer in America? So it says the median age is about 50. It's 47. Oh, wow, I got younger now. So now it's 34. Well, that's even better. And that's as of December 2020. And as of April 2021, let's see. Wow, young people are buying the hell out of homes. These are young millennials. It says 22 to 30 now. So, okay, it's not moving. Why is my Google not moving? Okay, what the freak? It was an advertisement. Okay, let's see. What age? Okay, so let me share that with y'all. Let's go here. Well, let's finish the 50s first, and then we'll talk about the age of the 20s. So again, you're paying off debts like a mortgage or a credit card. The median there, it says a repeat home buyers is 55. So by the time you're 55, usually you're buying a second home. So you'll have a second 30-year obligation. You're worried about covering your final expenses. You want assistance with estate or legacy planning. You want to supplement your retirement income with the cash value component of a permanent life insurance policy. So this is talking about living with life insurance. It says you want to supplement your retirement income with the cash value component of permanent life insurance policy. Now, this is something that I was about to speak with on Anton Daniel's panel before he paused, before he was going to have me come up, because he was used to what most people say, well, what's better, whole or term? And then you'll have agents with, a lot less experience who will say, oh, well, get term and invest the rest. And that's a great premise, but there's other reasons why you would get a permanent, and they just say, well, term or whole. And then people are like, oh, get a whole term. Well, you get a whole so you can borrow against it, but then you don't have to borrow against. So they don't understand how it works. Right now, someone like Anton, living in Michigan, I'm glad he's licensed in Michigan. He's the type of person that I would create a MET with. But again, you have to know how to do that in order to do that. Luckily, I'm also licensed in Michigan, so hopefully we'll have that conversation. But again, you want to supplement your retirement income with the cash value component of a permanent life insurance, or you want to protect your existing assets. You might not need life insurance if you're 50 or older, if you are financially secure enough to retire comfortably and take care of your financial expenses. Your children are all grown up and financially independent, and if you finish paying off all significant expenses like a mortgage, your child's college expenses, etc., and have a comfortable nest egg. The best types of life insurance for people 50 or older are term life insurance is a good fit for people who are looking for coverage for a set period. For example, you may feel that you need coverage until your kids are finished with school or until your mortgage is paid off. Permanent life insurance is a good option for people who want the security of lifelong coverage. As long as payments are made, it can be helpful with final expenses and legacy planning, and the cash value component can be beneficial to retirees due to the cash due to the cash value component and the coverage duration. Permanent life insurance policies are more expensive than term. Therefore, it is essential to ensure the premiums are within your current and future budget. Okay? And that's that. So now we're going to look at why it's important to get life insurance in your 20s. First, I want to look at this because I want to look at statistics. What the fuck? Okay. So, this says here, I don't know if you guys can see the size of the screen, so I'm going to enlarge it a little bit. Okay, this is a website called Statista. I went to it through Google. But it says here, that first-time homebuyers in the U.S. by age group, April 21st, 2021, by the Statista Research Department. Approximately 82% of Americans aged 22 to 30 who bought a home were first-time homebuyers. Oh, that doesn't mean... Okay, never mind. Whereas just under half of homebuyers between 31 and 40 bought their first home in that year. So Gen Z and millennial first-time homebuyers. It's no surprise that many Gen Zers born between 96 and 2010 and millennials born between 80 and 95 homebuyers are mostly first-time homebuyers. These homebuyers are in the early stages of their career or still studying in some cases and often struggling to repay student debt. So they need to save for many years before they can afford a down payment. Okay, and we're going to stop sharing that. And we're going to look at my screen. And we're going to share here. 1 second. I'm just going to share the entire screen because it's a little easier that way. Give me 1 second. Share screen. Boom. Let me just share the entire screen because it's easier that way. And we're going to go here. So, I've made Larry Graham, who is... We're going to do a 30-year term because right now he's in his 20s. Now remember, the thing I showed said people between 22 and 30 made up 82% of first-time home buyers, right? So the advertisement said, get term life insurance. So let's do this. Let's, hold on. Let me stop this for a second. Snuggles in the building. Boom. Sheet in the building. Boom. All right. So let's Google average price of home in America. $374,900. That's fucking hilarious. All right. So y'all see, the median home sales price is $374,900 as of the second quarter of 2021. It's a 16.2% increase from a year ago when the median was $322,000. So let's just look at a mortgage protection. Let's get a $375,000. Let's leave a little money for the family. So let's get a $400,000 life insurance policy, 30-year term. Larry Graham, he's 22, right? So let's take a preview at this 22-year-old Larry Graham at a term life policy. So we're going to take it. Actually, you know what? I should have done the comparison. So for $400,000, it's $52 a month. It's $600 a year. But for 30 years, from 22 to 52, God forbid he dies, his family will get $400,000. 22 to, where is it here? 52, year 30, right? So, boom. Then it starts to get more expensive year after year. You see, it's $4,500 for year 31 and $4,900 for year 32 because term is an increasing premium policy. So when they tell you, oh, yeah, get a term and invest the rest, well, there's ways to do that. So again, remember, average price of a house is $374,900. So we're going to round it up to $400K. So again, this is, let's do the print age 121. Okay, then let's do maximum value 95. All right. And let's do a whole life because we always compare whole life. And again, this is in your 20s. 400,000. Right? Now, we're not going to get into the weeds of this about different things like, riders, different ways you can set up, cash flow with it, way different. There's a whole bunch of different things you can do with life insurance. But we're just looking at a 30,000 foot view. So here goes a regular whole life. Okay. Now remember, we were talking about that cash value component. Now remember, life insurance grows at a compound interest rate. Now they're talking about, well, you want to build cash value in your 50s. Well, here's the thing. I talk to people when they're in their 20s, and I'd be like, yo, what kind of work you want to do? What you want to get in? I want to get money. I want to do anything to get money. I'm down to get money. I want to get money. Well, you got, and then they'd be like, well, I know I got to spend money to make money. All right. So at 20, right, for 10 years, right, you put away $3,000. So over the course of that 10 years, you put away 30 grand. And you have accumulation value or borrow against value of 22,000. So this is where they'd be like, well, that whole life is messed up. Well, that's the first 10 years. Now let's look at the next 10 years. Next 10 years, you've put in $60,000. Now your return is $2,786. Now that doesn't sound exciting for putting in $60,000. But remember, you put in this $60,000 over the course of 20 years. You didn't put $60,000 in at one time. Now let's continue here. Now you've put in at 30 years, and 30 years from now, remember, this situation, you put in a 30-year term. You put in $18,000, so you didn't put in a lot. And if you die, and only if you die, your family gets $400,000. That's it. But what if you live? Well, if you live and you've paid this, and now 51 happens, and oh, happy birthday to you, you're 52. You either need to pay $4,500 to make sure that if you die, your family gets $400,000, Or you can cancel the policy and try to get a whole life policy, but now you're 52, so you're older, and insurance is based on your age and your health. So you're simply older and less healthy for the fact that you're older, and ages and rates of mortality will make you older, and now you're also older and you have more expenses. So it's smarter to get it while you're younger and get a cash value policy because the compound interest that builds. So this one, you spent quite substantially a lot more, $60,000. And yes, your return is basically $2,000 if you cancel the policy. If you should die, your family will get $426,454. But I'll continue on. Let's continue to, what is this? Oh, I'm sorry, that was after 20 years. So after 30 years, you're 52. So now at 52, you've put in $90,000, but your return is almost $36,000. You would have, if you canceled the policy at that point, $126,908, putting $3,000 a year away. Now, there's no other account you can put that away in. I'll tell you to put that in a money market account with Marcus Millichap. You won't get that rate of return. So, as we continue, because that's just a regular whole life, right? Let's look at something a little fancier. Let's look at a limited pay. So we're going to look at the same thing, but we're going to look at a limited pay. So what's a limited pay? Well, a limited pay is very similar to a term, where you only pay for a specific amount of time. So in most term policies, this one happens to be what's called VP30, which is a 30-year term. They generally come in 10, 20, and 30-year increments. Okay? In those increments, after those terms or periods of time, you no longer pay the policy. But the policy also expires. You do have the option to continue having that coverage at a much higher price annually. Now, let's look at this, which is a limited pay whole life. Very similar to the other, and it's still a $400,000 face value, and this is for Mr. Larry Graham, who's 22 years of age. Now, as transparent as Anton is, he may let me do a full consult with him on his show. And that would be cool, even if he uses arbitrary numbers. So in this situation, the premium is substantially higher. It's $658 a month. Almost $8,000 a year. Holy smackerel, that's a lot of money. And after 10 years, you technically come out at a loss because you're only able to, if you cash out with $69,000. So you lost $10,000. So your local Prime America agent will tell you, see, I told you, cash value whole life's a scam. You lost money. Just get a term policy. Now you see this here? This left side which says contract premium and riders. So this is what you pay, right? Now I want you to notice it says contract year, age 23 to 32. 7901 is what the annual premium is, right? And after 10 years, you've paid $79,000. Your death benefit is increased, it's $402,000. But you're financially taking a loss if you cash out. But if you stay in, because, most investments are a 20-year horizon, you'll notice that year 11 through 20, you pay $0. But your cash value has increased. So your cash value is now $108,000, but you still only laid out $79,000. Also, your annual dividend has increased. So at this point, over the course of that 20 years, you've got $10,784 of a dividend Oh yeah, because life insurance pays a dividend. And this is a contract. So many people often sit down with me and say, can you send me this? And I say no, because it's technically not a contract until you've signed the policy. So it will be in a policy. So this is a proposition. So the only way it gets sent to you is if you sign the policy. So we generally have more than one SIP for that reason. Now let's look here. Year 30. You've still not paid a dime more than that $79,000. You're almost up $100 grand. $171,134. What does that mean? That means two things. What most people tell you about is your cash accumulation value, which is what you can borrow against. And then you do have to pay it back at a 7% interest rate. Now, if you don't pay it back, there's no severe penalty. Let's take this scenario where your death benefit now has increased to $511,000. And let's say you borrow $100,000 of your cash value. So now your death benefit would be $411,000. And then you blow $100,000 and die the night later. Because you didn't pay back the loan, the only penalty would be that your death benefit, your beneficiaries would receive $411,000. So you never actually have to pay back the loan. Now, there is another thing which is called the cash surrender value. So surrendering the policy means that you cancel it and you get all of your monies back if there are any monies due to you, available to you. So that doesn't usually happen for the first 2 years. But after 20 years in your 20s, well, damn, you could do a couple things. Remember, this $400,000 house, well, if we pull out an amortization schedule, let's do that. Amortization schedule. Amortization schedule, here it is. Right? So let's go amortization schedule from bank rate. Okay. So the mortgage, let's have some fun here. Let's have some real fun. The mortgage is $375,000. Let's say you got it. Let's do $400K, because no, let's do $374,900. Right? $374,900. Okay, is the purchase price. 360 months, interest rate 4.5%. So your monthly payments will be $1,800, $1,899 a month. Let's show the amortization schedule. So, and this is the monthly amortization schedule. So you close now in October of 2021. You pay $1,899.56. The principal, the money that goes to the principal, is $493.69. Right? And remember, I told y'all I'm going to show y'all how to buy a house early with a fucking life insurance policy. So let's do it today. Because now I'm going to show y'all why y'all should be paying me for this shit. I'm going to show y'all why when Anton brings me there, I promise you he will respect me enough to pay me for the console. Probably more than I ask. But, you know, wishful thinking. Anyway. The interest is $1,405.88. So the total interest is $1,405.88. So the balance is $374,406.31. So that's October 2021. Now we're looking at 30 years because people clamor to get their mortgages. Let's see. So 30 years from October 2021, right? When is that? Because we're looking at paying off the house, right? So October 2050, because it's I mean that's where we're at, right? So October 2050, you will have paid $1,899, $1,880 $18.16 will finally have gone to the principal and $83 to the interest, leaving you with $20,000 left to pay off. So in interest, you've paid $308,000, right? If I match it up with the amortization schedule, let's see here. So the total interest, the total interest, again, we're here in 2050, is $308,000, right? And so the payment remains the same, but the payment to your interest, the payment to your principal does increase. But again, the total paid in interest here is $308,000. Right? So, and that's why you'll hear Anton actually, he always talks about getting a 15-year mortgage. Right? Because a 30-year, you end up paying triple the price for the home. So let's take a look here. Let's go back. Let's go 20 years. But again, this is all you've paid in interest, so you still haven't paid anything off. Now let's just take a look at if this kid was paying $1,800 a month in a damn life policy. Let's go input premium. $1,800. Now this is just a regular whole life. First of all, let's just see how much life insurance $1,800 a month gets you. Because this is where we're getting into buy term, invest the rest. Because, this is a 10-pay. I got to change this to a regular whole life. Because the 10-pay is going to be different. Okay. But so that 10-pay means you only pay for 10 years and then you stop paying. We're going to do a regular whole life and see what $1,800 a month gets us. Right? So a regular whole life at 22 gets Larry Graham at $1,800 a month, the same amount his mortgage would cost. $2.8 million worth of life insurance. You think his family's comfortable with that? Is that worth more than that house? Because on paper, that makes him worth $2 million. On paper, that house only makes him worth $400,000. On the market, that house only makes him worth $400,000. On paper, he's only worth $400,000. He can actually go collateralize this life insurance policy and say, hey, give me $400,000 based on the fact that I'm worth $2 million. Ooh. Infinite banking. So, okay, over the course of 10 years, he's paid $216,000. In the first 10 years, it's a big loss, $100,000. And then over the course of the next 10 years, he's paid $432,000 out of his pocket. I'm sorry, that's the next 20 years, right? That's the next 10 years. Yeah, that's the next 10 years, he's paid $432,000 out of his pocket. But then his cash value has increased to $460,000. So then the next 10 years, he's paid $650K out of his pocket. But his life policy is almost $4 million. So if he dies, he's got almost $4 million. And he can liquidate this $1.021 million that he's accumulated in cash value, or borrow against that $1.02 million that he's accumulated in cash value. But again, that's an agent who's an average agent. When you're an all-star advisor like myself, we're going to do it like this. We're going to do an overfunding of a policy and see what that does. Remember, life insurance isn't the same. Life insurance is like a Mercedes-Benz. So you customize it. I have too many windows open. My computer is slowing down. Now remember, this is also just a regular whole life. So this will still get them $982,000 worth of death benefit, right? But again, somebody might come to you and say, well, I could get you more death benefit, but are you purchasing death benefit or are you purchasing life insurance? And that's the problem. Because year one, you put in $21,600. And then your cash value is $13,000 that first year. Now, you also increase your death benefit to $1.8 million. So the problem is, because you're overfunding the policy, you can't put more than $7,500 a year into the policy anymore after year one, because you beat up the cash value too fast. So over the course of 10 years, you put in almost $90K. You're almost at $60K, so it's a $30K loss. And then over the course of the next 10 years, you put in $160K. And then that 10 years, you're at a $20K gain. And then over the course of the next 10 years, you put in $238K out of your own pocket. Your death benefit is almost $1.5 million. So if you die, your family gets $1.5 million. But your cash value is also $396K. So if we do the math there, right? 238,905 minus 396,428 is negative 157,523. So at this point, over the course of 30 years, you've paid negative $157,523 to make sure that when you die, your family gets at least $1.5 million. Now, the way that you get that extra $157,000 out, or that $396,000 out, let's say, you know what? I got this last $20K on my house. I want to pay it off. Boom, one fell swoop, instead of paying more interest. Okay? Now, there's a way that normally I would do an amortization schedule all the way together and match it up with a mortgage. And we match up your premium and your policy to overfund and actually create that type of a situation. So let's do that, right? Because this right now isn't too sexy. And I know it isn't, and it's intentional. So now let's look at the Mercedes-Benz of life insurance, indexed, universal life insurance. Damn, this is going longer than I intended. It happens. All right. So now we're going to do the same 400,000. I'm going to input the premium. Now let's do this. Let's do the same $400,000 policy. Let's put percent of target. So firstly, we're going to see how much it costs to just get a indexed universal life. Right? So this is just pure life insurance. And this is why people say buying term is better, because buying that term policy or buying a improperly funded cash value policy is a waste of money. And they're absolutely correct. It'd be much better to buy term and invest the rest if you get someone who doesn't know how to properly fund your cash value life insurance. But let's take a look here. Now, there's a lot more legal jargon we can get into. I'm not going to talk about that right now. So it'll be $189 a month for $400,000 worth of life insurance. But it doesn't build a bunch of cash value. Okay? Over the course of 10 years, you paid out your pocket $22K, but you only got $13K worth of cash value. Over the course of 20 years, you paid out your pocket $45K, and you got $50K worth of cash value. Okay? And if you die, your family would get still only $400,000. So let's change that now, and let's do that to an increasing death benefit. And let's check how much it will cost there. So this one, same $400,000. Option B, which is an increasing death benefit, same $189 a month. But again, you're not going to build that cash value quickly, but your death benefit increases. So when your cash value increases, your death benefit increases. It's exact same cash value accumulation. But now let's make it sexy, right? Let's make it a little more sexy. So now we're going to input the premium. And put it at $1,800 a month, the same as the mortgage, right? Because remember, we're 22, so it's cheaper, right? We're not even going to be able to do $1,800 a month at $400,000. So I'm going to have to change this because it's going to be way too overly funded. So at $400,000, the most you could pay is $1,600 a month, $1,666.06, ironically enough. And this is still with option A. And then you can only pay for the first 5 years, and then you can't pay anymore until year 15, and then you start paying again. Yeah, this is way convoluted, so let me change this death benefit option. We'll do input premium, face amount, minimum non-bank. Okay, so now we're going to do input premium at $1,800 a month. And we're going to do something called a minimum non-met. So we're going to overfund the policy. So this is how you pay off that house early. Okay, so this $1,800 a month will get you $1.9 million worth of life insurance. And let's look at the cash value accumulation here. So out of the first 10 years, you put out $216,000. Your cash account value is $207,000. So that means you have liquid to borrow against $207,000. But your cash surrender value, should you decide to cancel the policy, you would get back $203,000. Now, should you sit another 10 years, you'll have paid $432,000 out of pocket. But your cash value will be $668,460, meaning you will be able to borrow against $668,460. However, should you decide to cancel your policy, you will have $668,460. And that's a guarantee. That's not if, that's not maybe, that's not but, that's not perhaps, that's guaranteed. And these are guaranteed policy values on scales. So this is a scale of right here that says guaranteed. This is guaranteed, meaning if everyone who has a policy with this company puts in a claim at the same time, you would at minimum still get this back, right? That's the absolute minimum guarantee. There's no way possible every living person who has a policy with one company or another is going to take the policy at the same time. It just doesn't happen. Well, it does happen, but usually those companies go into what's called rehab. Check out a company called North Carolina Mutual. But what they do is they freeze, they stop selling policies, and they make sure to keep at least the alternative scale values. Okay? So the alternative scale values are a lower market rate if the company is collapsing, because they have to keep this thing called reinsurance and what's called reserves, like a bank. But they have a requirement to keep much larger reserves than a bank, because insurance companies are banks. So at 42, you got almost $750,000, and you put less than $500,000 in. So now at 52, because people are encroaching their 50s, you put in $650,000, but your cash accumulation value or cash surrender value is pretty much double, right? Because you put in $648,000, but you've accumulated $1.5 million. Now, yes, it took some time, but what do you think happens with Dogecoin? Like, you don't think you're supposed to cash out in the weekend, right? Like, the people who got in, yeah, they're happy that it went to 50K, but like when they got in 2008 and it was 4 cents, like they had to hold on for dear life. Why aren't we holding on for dear life? See, all that other stuff is speculative. Those numbers do like this. Oh, it's up, it's up, it's down, it's down, it's up, it's up, it's down, it's down, it's up, it's up, it's down, it's double. This is plain English, black and white. You put in this money, I guarantee you got this. Ain't no ifs, ands, buts, or maybes, or what ifs, or what had happened. You put in this dollars, you get this. It's an amortization schedule. So it makes a lot of sense. Right? So now let's make it real sexy. Right? So let's go to option B, which is an increasing death benefit. Again, Larry Graham is 22. He's paying $1,800 a month for his mortgage. Oh, by the way, this is growing at a 6.2% compound interest rate. So again, $1,800 a month with an option B. Let's see how much, because people always like, well, how much does life insurance cost? $1,800 a month. That's why I always say, how much do you want to pay for it? How much is life insurance? How much do you have? Because that's how much life insurance is. We can set it up to fit in your budget. Mind you, I didn't change that $1,800 premium, but this one versus the last one. Remember, this one here, right? Let's look at this death benefit, right? So, death benefit, $1.9 million. Death benefit option A, monthly premium $1,800 for Larry Graham, age 22. Right? So the same thing here. Let's increase this. It's too big. Right? So now, Larry Graham, age 22, death benefit $588,017. Death benefit option B, monthly premium $1,800. What's the difference? Wait. Monthly premium $1,800, specified amount $1,979,385. Death benefit option A, prepared for Larry Graham, age 22. Wait, but it says here, prepared for Larry Graham, age 22, specified amount $588,017. Death benefit option B, initial monthly premium $1,800. Wait, but over here it says initial monthly premium $1,800, but I get $1 million worth of life insurance here. But why only get $588,000? Well, man, that's a ripoff. Now, is it? Let's see. So you pay that same $1,800 a month there as you did here, right? So you're paying the same $21,600 a year, right? There as you are here, right? Now let's see something. Over the course of 10 years here, you pay $216,000, but you have a cash accumulation value of $259,000. So you can borrow against $259,000. And if you cash out, you have $258,000 that you get back. While this one, you get more death benefits. So if you die, the people that you die, you leave more money, but you get less money in the interim. So yeah, people will tell you whole life is a scam, get term. Well, I just showed you the opposite. But wait, it's for Larry Graham. Well, wait, his premium is $1,800. But wait, his premium is $1,800. But wait, his death benefit, his specified amount, his death benefit is $1,979. $1,979,385. But wait, his death benefit is only $588,000 here. Man, get out of here with that life insurance stuff. It's so fucking confusing. Yet this is telling you in plain English. Okay, so let's look here. Over the course of 20 years, you put in $432,000. Right? Same thing, same $1,800, right? Because over the course of 20 years here, you put in the same $432,000. But he has $668,000 worth of cash value. Right? But here, he has $777,574 worth of cash value. So he's earning money. So in both scenarios, he's earning money, because both scenarios in 20 years, he's at a gain, right? Both scenarios. Now let's look at 30 years. Because, a mortgage is 30 years, right? So, right, this amortization schedule we had here goes from, right, we're in 2050, right? We're in 2050 in the amortization schedule, right? It's October 2021, right? Is the estimated payoff date is September 16th, 2051 is when you would pay off your house. Right? So that's 30 years. We're walking wholeheartedly into that to hope that the house stays appreciated, to hope that we don't have any having to fix it up, to hope that we don't refinance, because we're usually going to refinance to get a lower monthly payment, right? Or to get lower points, right? Okay. So, but no, I don't need that life insurance, because I'd rather pay $1,800 a month on a house. All right, so pay $1,800 a month on a house and pay $900 a month on the life insurance. So you'll have paid half of this, but you'll have about this much there, right? So let's look at 30 years. At 30 years here, you paid $650,000, $648K. Over here, you've paid the same $648K. But over here, you only got $1.5 million worth of cash value. So you only doubled your money in 30 years. Right? So here, $648,000, you've got $1.7 million, $1.75 million. So if I do the math, let's see. 648,000 minus 1,759,678. So that's negative $1,111,678. So you've paid negative $1,111,678, meaning that you earned $1,111,678 to make sure that when you die, your family gets at least $1.07 million. So you earned over $1 million to make sure that when you die, your family gets at least $1 million. And since, if you had kids at 22 and now you're 52 and they're in their 30s and you don't need that kind of life insurance anymore, so you're looking at winding down, well, okay, I put away $650,000 in my 401k. It's $650,000. Even if your company matched you dollar for dollar, $648,000 times 2 equals $1.296 million. So in the life insurance, without a match, you're still ahead, because you earned more. You earned $1.1 million off of your $648,000. You wouldn't have earned that off of contributing it to a 401k, because most people haven't saved up this much in their 401k over the course of 30 years. Let's see. Let's go to Google. What's the average amount of a 401k at retirement? So let's look at retirement. At retirement, it says here age 55 to 64. Damn, Google. So it says here 401ks are often one of the most common investment vehicles that Americans use to save for retirement. The assumption versus the reality, the actual 401k balanced by age. So the median age from 25 to 34 is only 10,500. Average is 26,000. The median for 35 to 44 is 26,188. The average is 72,578. The median for 45 to 54 is $135,777. The median, 46,000. Meaning half have less, half have more. The average for people 55 to 64 who are retiring, they have less than $200,000 in their 401k. $197,322. This is as of August 6, 2021. Google. This is stuff I've been saying for years, Brody. We clamor for that 401k. Sheeps to the slaughter. Shout out to the A-Game Nation. Know them dudes over there. Sheep Stay Sleep Tay VDS1. You know, all my peoples. I know niggas don't shout me out, but it be like that. It's nothing personal. It's personal. But 55 to 64 and you have less than $200,000. Remember, me and Talani was talking about this, and she was like, that's terrible. That's terrifying. She said the average house in her state costs at least $350,000. We just Googled that the average cost of a house in America is $374,900. Yet people will clamor for an $1,800 a month payment on something that will speculate. And they won't put money into a life insurance when I just showed you guaranteedly you put in $648,000 and I can show you how to turn it into $1.7 million. Over the course of that 30 years, do you think your house is going to appreciate that much? Some might. Some have. My landlord in Brooklyn bought his house for $89,000 in the 1980s. It's worth about $2 million today. 40 years. Good investment. Right? But not all real estate is going to appreciate like New York City, especially Brooklyn. Right? Now, yes, there's been a big ass boom, but do you think the economy is going to continue to do like that? Will we turn in Japan and have millionaires because now you get paid $2,000 an hour, but $2,000 an hour is the equivalent of yen, where you pay $1,400 yen for a burger, and it's the equivalent of like $5? What's this saying? By this or that, do you mean whole versus term? What do you mean by this or that? Where? I'm not sure what you mean by this or that. If you can ask again and clarify, that might. So, this or that is actually, I know what you mean by this or that. So this or that is actually two cash value policies that are exactly the same, Naima. So if you're still there, if you're not, it's easy to answer the question, because if she has it, it's probably confusing the fuck out of the rest of you. So what that means is this or that is both are cash value policies, and they're both with the exact same premium, but they have different death benefit amounts. So when people ask, well, how much is $100,000 or how much is a life insurance policy? I'm showing you that for the same exact type of policy, set up to be funded differently, you can get two different outcomes from the exact same premium for the exact same person, with everything else being the exact same. So this person, Larry Graham, is age 22, and the only thing that's changed is the way that we're funding the policy. And because we're funding the policy different, he's getting a different death benefit. Now, people will sell you on the death benefit. Well, hey, this death benefit for $1,800 a month, you're getting $1.9 million. You're not getting anything. That $1.9 million is if you die. The one that gives you more money is the lower death benefit for the same $1,800 a month. They're both cash value policies. Now, when I'm applying it to term, I'm applying it to those who sell term versus permanent. Not whole, but permanent. Because this is an investment grade life insurance. This is tied to the S&P 500. So it also pays a dividend, and it grows at a 6.2% compound entry in 6.2% monthly compound interest rate. So now at 30 years, you've paid $648,000. And this, again, the same, 30 years, you've paid $648,000. But you've only made your money to $1.5 million, where here you've made it to $1.7 million. Okay? And again, it continues on. You can go to age 62. We know people who are in that age range, right? Now let's look at that. If you just hold on for dear life and say, my exit plan is to, when I'm 62, I want to move to Turks and Caicos and fucking sit on the beach all day and drink out of coconuts and smoke and let the wind crash and the sand be on my toes. Well, we saw here that most likely, if you work most of your life, even if you work at a savvy financial institution, you're going to have at age 62 about $200,000. Stuffing that money into your 401k. Or you can stuff it into a life insurance policy. And yeah, you'll have put in $864,000, but maybe that's not how much you stuffed into your 401k if all you built up was $200,000. Let's say all you built up was $200,000 over the course of that, 40 years here. But, here you put in $864K. And, over the course of that 40 years, $3.6 million. Damn, Jack. So 864,000 minus 3,628,596. So that's negative $2.764 million, or negative $2,764,596. So you got paid, or you accumulated or earned $2.7 million to make sure that when you die, your family gets $4.6 million, or to make sure that when you retire, you got $3.6 million to take away, because your cash value, you can borrow against that $3.6 million. So let's say you want to go to another country and purchase a home, and you're concerned with a mortgage, or you're concerned with liquidity. You have this life insurance policy that's actually liquid enough for you to do that with. So you don't really need to worry about a mortgage, because you've self-funded. You've done what's called infinite banking. So that's just, she's saying what here? I see that, thanks. I have to make sure mine is set up right. It's not that easy, dear. Believe it or not. I'll tell you what. I am a truly an MDRT qualifying agent. It's 1% of the agents in 75 countries. It's a great thing. Look up Dave Kinder. I was going to qualify last year by submitting 122K worth of premium. I fell short. I only submitted 115K worth of premium. Hopefully this year I'll do it. You know, I'm falling very short of that this year if anybody wants to get a consult. So no, permanent is not the better one. The best one to have is a policy in force at the time that it's needed. Whether that's term or permanent, when you die, okay, God forbid, Naima, let's say last night you died and your husband and children or your family are dependent on you and you didn't come home last night. Do you think they care if it was a term or a permanent policy when I call them and I say, here's $500,000. Naima loved you so much that she said she's going to send you a check every month for the rest of, until this $500,000 is gone. And since we're going to put it in a money market account because it's going to come, you're going to set that up to come to me to set that up to go in a money market account and give them, money perpetually. They don't care if it's term permanent. You care if it's term or permanent because you want life insurance for the living. See, most agents don't do this. They don't ask you, what do you want your life insurance to do for you? So the next time you sit down with an agent, ask them, can you show me what my life insurance can do for me? If they just talk about death benefit, hang up, leave them, and give me a call. That's what you need to do in the first place. I'm licensed in many states. Salute to Rael. I ain't see you in the building, fam. So yeah, there is no particularly better one. There's situations. The best idea actually is something that Dave Ramsey, Sue Zorman, and many agents, even some in Prime America, mention, which is to buy term and invest the rest. Possibly, but a lot of agents don't sell what I sell because a lot of agents are trained against it. You likely do have a cash value accumulation policy, but it's not likely that, and you may even have a UL, but I highly doubt you have an IUL. Not diminishing anything, but it's just not a lot of agents selling in the industry. However, moving forward, so again, you're gonna have like 200K in your 401K. So this life insurance policy, what do you want it to do? I want to fund my retirement because it's a part of life. So, that's what I want to put insurance on. The fact that I plan on living to 62. And at 62, I want to have put $800,000 away and turned it into $3.6 million. Flip that for me, Trapper. Because I'm from the trap too. You know what I'm saying? Real life. Not throwing out shots, but it is what it is. Right? So let's go. So, we've got even more years we can go through it. But a great idea is to buy term and invest the rest. So, right? The great idea is make sure at 22, if I die, all right, well, my family gets $3 million. And if across that, 30 years, I don't die, cool. I don't get nothing from it, but I move forward. Now, that's actually untrue. There are certain states and certain companies that have something called ROP, which is a great, 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 great type of term policy. Now, it's more expensive than a regular term policy. But see, most people don't even know there's different types of term insurance. Just like there's different types of whole life, right? Like you have simplified issue, which is for lesser health, if you have health complications. And then they have guaranteed issue, which is if you have even worse complications. Then they have final expense, which is like you see on the commercial with Alex Trebek or Colonial Penn. But these are all whole life, but they're structured differently because there's also something called the cost of insurance. So the cost of insurance is much cheaper when you're younger. So very much like that amortization schedule, where more goes into the interest while you're younger, while you're paying earlier, and more goes into the principal the longer you pay into it. Well, it's actually different there. In the life insurance policy, the younger you are, the more goes into the Transamerica is trash, but if it's set up right, it can be set up right. I had an IUL with Transamerica, but I got rid of it because I could only afford $200 a month to put in, and then soon I couldn't afford that. That happens generally. There's a lot of things you can go through. If it's been less than a year, you can actually get the policy reinstated. So don't listen to that Transamerica is trash, because all companies are trash, right? It's like McDonald's and Burger King, right? They all have the exact same thing. It's just, what suits whom best. So all companies are trash, okay? So I'll tell you that because I'm a broker. I don't belong to any one particular company. All the companies are exactly the same. Some have higher rates and dividends. Some are a little more affordable, and you can get bells and whistles. But pretty much, they're all trash. Like I said, it's McDonald's, Burger King, Dunkin' Donuts, Tim Hortons, Krispy Kreme, Carvel, 31 flavors versus Dairy Queen. They're the exact same shit. Okay? It's just one agent's going to tell you, my company's been... And by the way, just so you guys know, and this may help you to stop like standing up agents and shit. Okay, we pay money to represent those companies. So like even your local Prime America agent that like people will shit on, because like even you'll hear me shit on Prime America, right? Even them, they have to pay to be a Prime America representative. They got to pay money to Prime America to sell Prime America products. That's kind of fucked up. So they got to pay money before they can sit down with you. And we work on 100% commission. So when we sit down with you 3, 4, 8, 16 times and you want to think about it and you're like, damn, this motherfucker broke. Nigga, I work on 100% commission. So while you sitting there, for example, Naima, the fact that you couldn't afford your policy fucked up that insurance agent. Because let's see, if you paid $200 a month, he got paid $1,200 for that policy. So the $1,200 that he got paid for that, if you cancel the policy within 13 months of you getting it, they took $1,200 out of that man's mouth. So he had to go make another $1,200 to make up for the $1,200 that you unfortunately cost him. Now, I'm not saying that's your fault, and it's a dirty biz. We got into it. Just like black men like to go sell drugs and go take fucking financial chances and penitentiary chances, but won't do some shit like sell life insurance. So I'm not going to be mad at that, because I know niggas who sell drugs. Right? Like I said, we knew the job was hard when we signed up for it. So don't think I'm blaming you. I'm just allowing people to know shit happens. You be like, damn, I'm swiping my card left or what the fuck? These niggas just took $1,200 from me. You done paid your bills. You know what I mean? It's a hard life. I also had Transamerica, but our only problem was the guy I was working with didn't have time to help me save money with the life insurance policy and get me none. Yeah, well, again, a lot of people, we work on 100% commission, so we often, there is a pressure there. Now, I have found that I've moved to fee for service. So to do a sit with me, you have to pay a fee. What I found is, however, people feel much more comfortable sitting and paying a fee because you're like, all right, well, you already got something out of this, so you're not going to try and pressure me into buying something. You're going to advise me as to what's the best option for me. And that's pretty much all I want to do. Because at the end of the day, the pay is great. Because at the end of the day, Naima, if you kept your policy, we get what's called residual income. What does it now? I'm telling you guys this stuff. A lot of people don't want us to, but there's rules and regulations and laws in the state of New York that actually require us to pay this type of stuff. To tell you this type of stuff, right? All you actually have to do is ask your financial professional, your CPA, your financial advisor, your tax accountant, how do you get paid or how do you get recompensed? They'll usually give it to you in their contract. Your real estate agent, all of that shit. Especially knowing I couldn't pay every month. At least I got my money back when I canceled my policy. So you had it for a couple of years. If you had it for a couple of years and you got some money back, then you're okay. What that means is they've done what's called considered earned their commission, which means that you kept the policy for at least a year and a month, which is pretty fucked up because no other sales cycle do you have to sell something and the person has to keep it for a fucking year and a month or they take the money back from you. Like, first of all, I got to pay you to use your name. And this ain't just Primerica, but I definitely want to bigs them up because I shit on them. Like I said, every company is trash. Transamerica too. The guy who works for World Financial Group, Transamerica, that tried to probably recruit you as well as sell you life insurance, they have to pay to be part of that group. The people of PHP who probably sold you another policy and tried to recruit you, they have to pay. The people of, FFL, who also have to pay a fee and try to recruit you and try to sell you a final expense. Yeah, the people of NFG, or National Income, or it might be American Income Life in some states, tried to recruit you, told you they sell the unions. Oh yeah, this business is a cut teeth business. If you ain't cut for doing self-employment for the first 2 years of being your own boss, they'll teach you this. But if you do this for 2 years, you can't work for nobody else ever again. You have to be your own boss. You will get fired from every job you have. Because you will have to be your own boss. This is some fun shit to do. It's real fun now that I'm showing you how to turn $800,000 into $3.6 million. That's liquid. Because remember, this column is your borrow against value, but this column is your cash out value. And this column is your paid in value. Remember, this column is worst case scenario if everybody who on earth who has a policy with this company puts in a claim today at the exact same time. This will never happen. This is if we crash and we got to sell the company, this is your lowest. So at minimum, you have made $1 million. This is what's going on today. And this is based on the S&P 500. So let's look at some of this legal jargon here. Okay. I'm going to look at the S&P. So let's not look at the lifetime income, even though lifetime income is there. And IRC 7702 is the Internal Revenue Code change. So actually, this is about payments. Look at the... so basically, this is what we're explaining here. So these are the assumptions based on your loan charge of 30%. If you were to take a loan and your account value before activation of a loan, based on $1 million. Okay, and this is issued at age 45. Okay, so your disbursement factor, basically, if the S&P index is above that 3.77%, If your option B, your increase will be at least 4%. If it's the account value before activation or 1 million of value, then the factor will be divided by 12. So initially, at that level of 3% or the increasing percent, your monthly disbursement for 1 year is $1,500. Or on the increasing, your monthly disbursement for a minimum of 1 year is $1,083. This is if you, at a specified age, do what's called a disbursement or stop paying your life insurance policy. But for tax purposes, don't take a lump sum, because if you do take a lump sum, you would get a 1099, and that 1099 would have you pay the income taxes on that money. So you would do a disbursement, and we would pay you basically a pension of either $1,500 a month for at least 1 year, 2 years, 3 years on until the money runs out, the cash value that you have in the policy. And as the cash value decreases, your death benefit remains. But anyway, it's 10 o'clock. I'm supposed to be watching the game. I'm about to hop off of here. So, ladies and gentlemen, if you're enjoying my content, make sure you hit the like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. You know what? I'm going to start trying to recruit too. The reason I'm recruiting though is because due to being at the Conference of African American Financial Professionals, only 6% of the licensed financial professionals in this industry are Black. So you damn right we're recruiting. And you damn right I'm proud of those Prime America agents for recruiting. Keep recruiting. And I tell my friends this all the time, because they come to me, they be like, well, what do you think about Prime America? I tell them this. It's a great way to get your license for cheap. Go sit with them for 3 months. Don't do any business. Then leave them and then come to death row. Now, then I'll be like, then, come see me and you could get with, or go to, certain companies that have great training. So certain companies have great training. A lot of them are going to throw you to the wolves. But if you go to corporations that have great training, you'll always be great. I offer wonderful training, as you can see. Imagine when I'm sitting down with you and going into this in depth. I know I done dropped a bunch of science on y'all, dropped the names of companies that you had no idea and other companies have no idea exist. But I digress. So remember, ladies and gentlemen, wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. Wipe ass, work in progress every day and see success. And remember, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute. Remember, September is Liam, Life Insurance Awareness Month. Make sure you go to www.lifehappens.org and make sure you check out their life insurance calculators. It also has a thing called a disability insurance calculator. And if your insurance agent didn't set you up with an estate planning attorney, or at least ask you if you'd like to be set up with one, then they failed you. Why do I say that? Because our job isn't done with just getting you a life insurance policy. So I talk down to attorneys, because attorneys are nothing but a dime a dozen. You know why? Because they need professionals like me. They need financial advisors. We add value to their practice. Without us, they're just some fancy talking, fast talking folks who make a lot of money and charge you a lot of money to talk for you. But you can send in a pro set. You can get them to send you that for $200 and represent yourself, Moors. But are we talking or are we talking? See, they say I talk a little fast, but see, if you listen a little fast, I ain't got to slow down for you to catch up. You know what I mean? See, sometimes that's the way things go. I got that from my daddy, though. Here we go. You know what I mean? Really, though. Yay. It's the League, bitch. LXG, shout out to the League of Extraordinary Gentlemen. You got the portrait of Dorian Gray, forever young in the motherfucking building. It's your boy Jeezy Jones, 2Gs, LXG, Snoopy Jones in the building. Yeah, we amping it up. Shout out to all my followers, all those who come in the future. If you don't like provocative language, I'm sorry, I might not be the person for you. If you like knowledge, then I'm the person for you. Those who need to find me, you will seek what you will find, and you will find what you will seek. And let water meet at its level. Ha ha! Anyway, ladies and gentlemen, wife ass work in progress every day and see success. Wife in progress every day and see success. Work in progress every day and see success. And again, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept that challenge.